Well, good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Advisor Legacy. And with me today is Todd Doherty, who's our Vice President of Mergers and Acquisitions. And Todd will be our presenter today. And as you can see, our topic is business valuations. Before we get into the content, though, I'd like to tell you just a little bit about who we are. Advisor Legacy is a full-service practice management firm that specializes in coaching, practice management, and all kinds of M&A activity. It doesn't really matter where you are in your career, whether you're growing and scaling or whether you're to the point where you're living your dreams and preserving your brand, or if it's time to leave a legacy and get out of the business. We have services that you can leverage. So we offer executive coaching, which is designed for the owner of the practice. We provide buying opportunities through our advisor legacy sales process. We offer both legal and lending support. We do continuity planning to protect the value of your practice in the event of death or disability. We offer deal support and we offer recruiting. If you're already an established business, you may want to get some help doing some specialty coaching on particular areas. Perhaps get a business valuation, although I think business valuation should be used all across an advisor's career path. Again, if you haven't established a continuity plan, and then succession planning, both internal and external. If you're at the point where you're looking to leave the industry and move on to the next phase of your life, we can help you find a buyer for your practice if you don't already have one identified. We can help you handle the sale from start to finish through our deal support services. We also work with law firms that will draft all the legal documents, and we even offer escrow services, which are often used when doing deals. So whether you're growing, scaling, preserving your brand, or leaving a legacy, we really have services for advisors all across the different career path curve. So with that, I'm going to turn it over to Todd, and he's going to take us through the content for today, which is business valuations. And then at the end of the session, we're going to open up to some Q&A. And what we have found to be best is that if you type in your question in your control panel, then when the presentation is over, we'll read through the questions and do our best to answer them. It is also best that you type in your questions as we go, as they pop into your head, so that we'll have questions queued up at the end of the session and not have to wait for people to type them in. So with that, Todd, I'm going to turn it over to you.
Thank you, Tony, and thanks to all of you for taking time out of your schedule to join us today. Looks like we've had quite a few people register for this particular subject. For most financial advisors, the value of their practice or the equity in their practice is their largest personal asset. Our average valuation today is just shy of $3 million, and it's certainly a significant asset, even if it's not quite your largest. And like most assets, it needs to be managed. Unfortunately, a lot of financial advisors assume that a practice valuation is something that they only need when it comes time to sell their practice or if they're acquiring one. But as you can see here, there's quite a few reasons why financial advisors use practice valuations. Certainly for acquisition or succession is one of the larger ones or larger reasons. For bank financing, if they're getting a line of credit or so forth, valuations are often required by the lender. Valuations are also used for creating continuity agreements to protect your practice in the event of death and disability, or buy-sell agreements to define the future sale of your practice. But of all these reasons, equity management is the number one reason that financial advisors get practice valuations. And it really can be impactful in the long-term value of your practice to manage it along your career path. In fact, we've had advisors that have improved the value of their practice by as much as $1 million in as little as a 12-month time frame, simply by identifying the key drivers of value and making improvements in those key metrics that the valuation will illustrate to you. It's certainly exciting to manage the equity and see it increase over the years. But what a valuation can also provide is letting you know if there's any threats to the value of your practice. There's a number of reasons that valuations can actually decline, including the age of the clients. Practices tend to have declining profitability as the revenue gets larger and larger. And so tracking those items that could potentially hurt the value is also very important. So a lot of advisors tend to think of assigning value to a practice using multiples of revenue. And we have a good white paper about that, why multiples are not a good idea or a good way to assign value when it comes to any real event where the equity is meaningful. Multiples are largely used as indicators of averages or rule of thumb type of understandings, but if you really need to manage the equity or you're going to monetize it, you want to have a formal valuation completed. The way that evaluation works, and specifically our methodology, is we use two different methods of value, and then the number that we assign based on fair market value is the average of those two approaches. So the first approach that we use is what's known as a market-based approach. And it's helpful to think of that as similar to how a home is valued using comparables. So what we're doing in the market approach is we're looking at the key performance metrics of your practice. We're comparing those metrics to our benchmarks, and the benchmarks are based on all the valuation data that we collect in approximately a sample size of a year. And in comparing your metrics to our benchmarks, we can determine where the practice is above or below average. And the things that you might think of going into that, would be like the quality of the revenue. Is it transactional or recurring? The age of the clients, demographics of the clients, client segmentation, asset velocity. There's a lot of good data that goes into those comparisons. And then based on the overall quality assessment that we make, we can compare your practice to the sale of similar quality practices. The other approach that we use, which looks at value in a very different way, equally important way, is what's known as an income or earnings approach. And really, the objective of an income or earnings approach is to assign what's known as enterprise value, or that's the value of the operations of the business and very specifically the resulting profitability. So in the income approach, we use a discounted cash flow calculation to value the future revenue stream of the business discounted for time. And so you're taking the existing revenue, you're applying a growth rate, and you're applying a discount rate, and the discount rate is largely a buildup of the risk and opportunity cost if someone is to invest in the practice. The earnings approach or income approach is, again, a very different look at the value of a planning practice, and it tends to be very reflective of efficiency. So are you operating more profitably than the average for a practice of a similar size, or is your profit lower than a similar size practice? And it assigns the value accordingly. You might ask the question, how do you determine the quality of a practice? And I mentioned, we're looking at the key metrics, and that's one way. But one of the primary areas that we focus our analysis on is what's known as client segmentation. And what client segmentation is we take your client group and we break them down into three segments of clients. So the first segment is what we refer to as a basic client. They're under 100,000 in AUM. The second segment in the middle is what's called a high value client. They're between 100 and 500,000 in AUM. And then the top segment we refer to as affluent clients, and they're 500,000 in AUM and above. What's significant about this is the ratios of those three segments relative to their contribution to the practice. So here you can see we start at the bottom. The basic client segment this is the averages, is 33% of the total client group, and they produce 5% of the revenue or GDC of the practice. If we look at the group in the middle, the high value group, they're 34%, but it's closer to a 1-to-1 ratio of the contribution that they make to the revenue and AUM of the practice. They're at 29%. of the revenue. And then typical kind of 80-20 rule at the top end, while you only have an average of 29% affluent clients, they contribute 66% of the revenue of the practice. And usually it's about the same or a little bit higher in terms of the total AUM of the practice. So managing those three segments is really the highest correlation to overall efficiency and profitability. And many times advisors will tell us, well, I can have as many of the low end clients as I choose because I don't spend the same amount of time with them. But that assumption is not supported by the data because the differences in profitability of the three are simply not able to be made up by changing the amount of time that you spend on the clients. If you look at the average revenue at the bottom of the slide, you can see that the basic clients are 350. You can take 40% away from that from an average expense ratio. The high value group in the middle is 1900, and the affluent clients are 8400 average revenue. So there is no difference in time spent on the clients that can make up for those differences in revenue and profit. And really, at the end of the day, it comes down to managing the ratios. There is an appropriate ratio of segmentation, or I should say a high performing ratio of segmentation that we look for. And generally, what we would like to see in an ideal practice is 25% in the basic group, 35% in the middle, and 40% affluent. That tends to be where that you really get a highly efficient and highly profitable practice. What happens to practices that are not managing segmentation is as they get larger and larger, they become less and less efficient and less profitable. And the primary reason behind that is that if they're not managing the size of the lower end, the basic client group, the alternative becomes hiring an associate advisor to service those clients. And there you've created your largest expense relative to your lowest productivity. So segmentation is a big area of determining the overall quality of the practice and also the highest correlated item to efficiency and profitability. When we look at all the data that goes into the model, and there's quite a bit of data that we collect, not too difficult to get for most advisors, but it's a fair amount of data. Certainly not all of it is equally weighted in the valuation result. So a few years back, we did a regression study on all the data that we have in our model to determine what are the top three items that influence evaluation positively, and what are the top three items that detract from the valuation or have a negative correlation to value. What we found in doing that regression study is what you see on the slide here, whereas the top three items that impact a positive valuation result are number one, the quality of the revenue, or literally the ratio of recurring to transactional revenue. The good news on that data point is that most practices are really following a fee-based model now, and average recurring revenue is around 90%. That's a pretty sharp increase over the about last 5 years, where it used to be around a 75% average ratio. But most practices really have adopted more of a fee-based model. The next impactful item is the profitability of the practice. As I mentioned, on average, as practices get larger and they move up into subsequent revenue ranges, the profitability actually decreases and efficiency decreases, largely as a result of client segmentation not being managed. Those practices that do a good job of managing segmentation can actually maintain very high profitability regardless of the revenue ranges that they move up into. Certainly practices with, average of $1 million client tend to have very high efficiency and very high profitability. What we see in profitability in terms of impacting the valuation is that practices that have an expense ratio above 40% really are constraining the value of their practice, and it's more constrained the further away above 40% that you get. If your operating profit ratio is below 40%, it improves the value, but it has a decreasing impact the further below 40% you get. So it's a little bit of an opposite impact from that 40% point. And then the last item that really impacts a positive valuation goes right back to client segmentation, and that's the percentage or ratio of the high net worth clients. As we saw on the previous slide, the differences in profitability are so substantial when it comes to that particular segment, that if you can really maximize that, you're pretty much guaranteed to have high efficiency and strong profitability of the practice. So then we can look at what are the three items or the top three items that detract from the value. And as you can see, the number one item goes right back to client segmentation again, and that's the number, or maybe more appropriately, the ratio of the lower value or the basic clients as we refer to them. And that impacts it for a number of reasons. One is, the obvious one is that there's not much revenue there, tends to be not much assets there, and the profitability or the efficiency relative to the time that you spend with those folks is very, very low. There's certainly an appropriate group that should be in the lower end client group. Generally speaking, that would be, the clients that are the heirs of your affluent clients, or younger folks, with good incomes that have a strong ability to grow their assets over time and become your high value and affluent clients. And really, they're the future of the practice if you think about it that way as well. So it's not the case that you shouldn't have any, but you want to certainly manage those ratios of segmentation. The next big ticket item as a detractor, and this is very common, is the age of your client group. We have a proprietary analysis in the valuation that looks at the age of the clients, the assets that they hold, and the revenue that they produce, and can really look at that over a 10-year time frame and determine how long is that client group going to continue, to grow before they start to decline by withdrawing assets and reducing their revenue. So the age of the clients generally tells us for most practices that their existing client group has approximately 3 years of growth left in it. That's the average result. And then the last negatively correlated item, which is a little counterintuitive, I think, has to do with the number of professionals or servicing advisors. I say that's counterintuitive because you might think, well, the bigger the practice, the more advisors, the better. But the reason that we found that data point to be counterproductive to the value is that it really is representing people who are not managing their segmentation. They're hiring associate advisors to service low-end clients that are not producing. That takes away from the efficiency and profitability, which substantially constrains the value of the practice. And that's why we see that in the top three items that are negatively correlated. So a good way to look at the impact of these key performance metrics on an actual evaluation result is what we've done here. As you can see on the slide, we've taken, and these are actual valuations that were done, we've taken two practices where if you were to look at the high level metrics of the practice, and if you were to use simple rule of thumb methodology for valuing them, you'd get a very similar result. So as you can see, practice number one has 619,000 in revenue. Practice number two, 621, almost identical. Practice one, 70 million and change in AUM. Practice two, a little bit higher at 74. But once we look under the hood of these two, you can see big differences in those key performance metrics that we just talked about, the three that influence a positive valuation and the three detractors of value. So practice number one has 86% recurring. Practice number two is above average at 96%. Both of those are good, but certainly 96% is very good. Operating profit of number one, pretty low at 22%, whereas number two is 57%. That's quite a good ratio. Percentage of high net worth clients, 14% for practice number one, and 45% for number two. So number two is actually in the range that we look for, or actually slightly above it for very high efficiency in terms of their segmentation of clients. And then if we look at the detractors of value, we see that number one has 42% low end or basic clients and practice 2 has only 25%. Again, that's the ratio that we look for. In terms of older clients, their average client age in number 1 is 62 and number 2 is 55. 62 is about the average for practices in general for the client group overall. And then if we look at number of professionals, the last detractor value, there's 3 in number 1 versus 2. So while those practices look very similar, at the high level, looking at revenue and assets, the actual results of those two valuations is considerably different by looking closer to the data that really drives the value of a practice. So number 1 came in at just north of 1 million. And number 2 is closer to 2 million at 1,718,000. So I think that does a good job of really illustrating how, it's really in the details and driven by those, data points that really can influence the valuation result. Another thing that we like to see, based on using actual professional evaluations versus the rule of thumb, is the impact that it can make, that using an actual evaluation and not applying a rule of thumb. And this graph does, or this illustration does a good job of showing that. So what you're looking at here is this is our current average valuation. So of all evaluations we've done approximately the last 12 months, the average result was 2.7 million. That practice represents the average size of 163 million assets under management and 1.1 million in gross revenue. So the average valuation result was 2.37 times the gross revenue. If we then look at the top 20 and bottom 20% of results, we see that the bottom 20% comes in at a multiple of gross revenue of 2.18 or 2.5 million in dollars, and the top 20% comes in at a multiple of gross revenue of 2.64 or just north of 3 million. So the range of value that you see here, and again, this is applied to an average size practice, is 538,000 between the bottom 20% and the top 20%. And that range of 500,000 is really representing the qualitative differences between the two practices. So the market-based approach and the income approach, the sum of those differences in one practice to another can be as much as 500,000 on average. And the reason that this illustrates the use of rules of thumb not being good is it would be very easy to be off by 100,000, if not more than that, when it comes to the true value of the practice. And certainly far more risk there than the cost of getting a professional valuation done. I mentioned earlier that a number of years ago, we developed a proprietary analysis around the age of your client group and the impact that the age of the clients will have on the future growth of the practice. The reason that we did that in the first place is we had always worked under assumption that the client age was a significant factor, if not maybe one of the most significant factors in determining the long-term growth of your practice. And I'm sure most advisors share that assumption, but at the time we didn't have the ability to quantify it. Fortunately, we had a very significant database, over 50,000 data sets of client household data. And we were able to go into that and do a regression study and assign specific average growth rates for each age of client. So each age has a specific growth rate associated with it. What we learned from building the model is that the tipping point of client growth is the average age of 70. So up to 70, there's variable positive growth rates for each age. And after 70, there's variable negative growth rates. And of course, they would become more negative the further away you get from 70. So then what we do is we take your client group by segment, and then we look at the age, the assets, and the revenue, and run them through those growth rates over a 10-year time frame. And again, what we've seen on average is that most practices, because their clients are aging, funny how it happens each year, And, the majority of the assets are held by the clients who are either close to or already at the average age of 70. So the average result that we see is that, the practice is going to peak with the existing client group, at least within 3 years of the valuation being completed. That's what we generally see. It's actually unusual or a bit of an outlier that we see a practice with a young enough client group that holds enough of the assets of the practice so that they would continue to grow closer to the 10-year mark. That's actually quite an outlier. And what this information provides, which we have found to be very useful, very valuable to the advisors, is it largely identifies when the equity and value of your practice will peak. Now, certainly you could go out and say, I'm going to be really motivated to acquire new clients, going to market again, not just rely on referrals. But what we know is, most people who are closer to retirement are not going to do any of those things. They're really relying on referrals for any growth that they get and tend to be having negative growth the closer they get to retirement. So it can really help you identify, when is it time to monetize the equity? Of course, you always want to monetize equity as close to the peak as possible. And there's a lot of options for monetizing equity, even if you're not ready to retire. There's a lot of what we call sell and stay strategies, which we also have a recent white paper on those subjects as well. So while client age is not the only impactful growth factor, we find that it tends to be either the largest impactful factor or one of them, certainly. And then there's other things like the market and so forth. So that's about the valuation process. Our own valuation, as you can see, we've won a few awards for it in the industry. We have the Max Val predictor that I just showed you. That's a proprietary analysis around age. And I think one of the areas where our clients get the most value out of the valuation is that once we send you the deliverable, we spend 45 minutes going through the results with you. And especially for those who are doing asset management, or excuse me, equity management, they tend to take a lot away from that because we can really drill down on, how is your practice performing for those key performance metrics? What are the opportunities for improvement? And oftentimes, significant opportunities to grow the value of the business over time. It's a pretty easy process to get started. So you go to our website, www.advisorlegacy.com. You'll pay online with a credit card. Standard retail price is $12.95. There's quite a few firms that are partner firms of ours that get a $300 discount. You'll see those firms listed when you go to place an order. As soon as your order is received, you'll get the data collection instructions in the email. We have a couple of evaluation coaches who can help you with data collection if you have questions. Pretty straightforward. We do need a fair amount of data, but we've tried to keep it as simple as possible. And then within 10 business days, normally the results are delivered. We send you the deliverable. And at that time, we schedule the one-on-one consultation to go through all of those results with you. So with that, I'm going to hand it back over to Tony, and we'd be happy to answer any questions that you have about practice valuations or anything related. Thank you.
Great. Thank you, Todd. And again, if you want to order a valuation, let's go to our website at advisorlegacy.com. You'll see the take action button and the drop down. The first one is purchase a business valuation. So at this time, what I'd like to do is answer any questions that you have. So hopefully you folks have gone in and put some questions in there. So let me go take a look and see what we have for questions. All right, the first question is from Pedro. How do you suggest one best uses a letter of intent as a time frame parameter by which two parties agree to various subjective and objective hurdles before an actual deal is designed or agreed upon? Todd?
Go ahead and take that one, Tony. Yeah, sure. So I think the use of a letter of intent or a term sheet, which is what we use to define the intentions of both parties, is a good way to establish the understanding between the two parties in a simple manner that allows them then to agree to move forward in the process. What we don't do, which I think was more common years ago, is assign some type of penalty to a letter of intent saying, if you're going to go through this process, and you decide to pull out of it, there will be a monetary penalty. That part I don't agree with, and I think, if a deal shouldn't happen, it shouldn't happen, and working on the letter of intent or the term sheet is a good time to put in the appropriate amount of time into a deal without having a lot of risk in it. And if it looks like it shouldn't work out, then you both walk away from it. So a letter of intent, I agree, is a good idea. We use simple term sheets for that same purpose. And it's just describing the intentions of the two parties to then proceed to get legal agreements completed.
And Pedro had another question, Todd. It's, can you please comment on recurring revenue from a 401k versus a private client or an individual? In other words, the 401k plan is going to provide consistent revenue, maybe 25 basis points on the plan assets. Would that be considered recurring revenue, just like, let's say, a managed or wrap account at the individual level?
Yes, we would consider that recurring. A good point that you made about the asset velocity being a little bit lower. But we've also found, that business lane to be a good source of, of new asset management clients as well, or retail clients. So I think it serves, two purposes. It is in itself a good recurring revenue business model, but also tends to lead to, acquisition of clients over the longer term as well.
So we have another one. This is from Anonymous. I haven't heard this one before, Todd. So it says, have you seen or do you recommend an advisor borrow money against his or her practice to be able to diversify the concentrated value of the practice without having to sell the practice? In other words, all their chips are in one spot.
Hmm. That that is a new one. Good question too. Yeah, I'll have to think about that for just a second. So I guess it would be a little bit rate dependent, I suppose, right? And interest rates are fairly high right now. When we were in, a historical low rate environment, maybe that would be more attractive. I guess my first response to that would be there's ways to take equity off the table before you retire. I might consider that first rather than paying interest on a loan, if I understood the question correctly. There's a lot of ways to monetize equity. As I mentioned, we just released a white paper on that very subject. So you can sell and stay, you can sell a portion of your equity, you can sell a partial client group to monetize equity. And when you do any of those things and take equity off the table ahead of retirement, you're also taking risk off the table because, while we know today's market for practice sales is probably the best we've ever seen, you just never know what's going to happen in the future. And so if you monetize equity at a high point, then you take the risk of having to monetize it at a lower point later. I suppose it's similar to, not keeping your clients in an aggressive portfolio when they're close to retirement.
I think another way to look at it is if you had to place a bet, which one's going to grow faster, your practice or another investment? And if the other investment's going to grow faster, you'd have to subtract the cost of the interest to make that investment. So I guess that's how I would look at it is where do you think you're going to have more growth in your practice or in another investment outside of your business?
Good point.
Well, it looks like that's it for the questions. So I want to thank everyone for attending today. You will receive a replay of today's presentation. And feel free to visit us at our website and to reach out to us. We'd love to help you. Hopefully, you'll join us for our next one. You'll get more information about upcoming webinars in the near future. Thank you.